All right. Well, everyone, we can officially get started here. Welcome to our roughly monthly, every 4 to 6 weeks, Patriot Investor Virtual Meetup. This is our third one, and this is the first one that we've had a guest speaker for. It's a good friend of mine who we actually used to have a physical meetup here in the San Diego area until about a year ago. Julie Peterson. So we'll do a quick intro here in just a minute. Who we are real quick. Brett and JJ and I, I'm sure anyone here knows one of us but possibly not, because I guess there's people who saw this on through ADPI, and heck, we welcome anyone. So my name's Greg. I've been a multifamily investor since I started off as a passive investor in 2015, which is right when I retired from the Marine Corps. I was a combat engineer officer in the Marines for almost 20 years. I live just north of the San Diego area in Temecula, California, but not for a whole lot longer. I'm going to be moving to Arizona here later this year. And then my partners, JJ and Brett Hadley, we have a deal together in Fort Worth for the last 2+ years we've been working together. And so I'll let Brett give y'all's intro.
Thanks, Craig. Welcome, everyone. It's an absolute pleasure to be in the same room with two of the guys that are partnered up with me right now, and Greg and JJ. That's how fast we have grown, is having the ability to first having our military network, and then cross-pollinating. That's how Greg and I got in touch with each other. We joined the same mastermind group, the Sumrock group, and it's just incredible that I hear people all the way from Kuwait talking about dialing in and wanting to build relationships. You're doing the right thing. And 5 years ago, would not even imagine how fast we've grown, and to be in a position that we are in now to help our service members. And we're a part of the 10X Vets. We're a part of the ADPI community because of that. We love to give back, and I'm on my 19th year in the Air Force, and looking forward to jumping all in. And in 9 months, just gonna be full-time and doing real estate because we can. Because you guys are doing the same thing right now, in advance, and you're making that move, and you're taking action. You're jumping on calls at 7 at night or 6 at night, or wherever the case may be, even in Kuwait in the morning. So I want to give everybody a round of applause for taking that step and getting out there and learning more. JJ, I'll turn it over to you.
Yeah. Thanks for joining, everyone. JJ Hadley here out of Rock Springs, Wyoming. I'm I like to call myself the asset manager of the deals that we do. I like to take the business plan and run it start to finish. Brett and I started buying smaller multifamily units in 2019, joining calls like this, learning about real estate. And now we've got about 750 units in our portfolio and about 45 million in assets under management. So this is a good place to start, and can continue to learn. Thanks for joining.
And who do we have here today? We've already listened and heard from several folks, and so thank you all for coming on and talking. But we have the Blue Sky Investor Group club members. That's the Greg Butchers you see in the background of Greg. We've got our investor group members, and then the guests. That's awesome. So anytime we get referrals and folks that want to bring other folks on board as well, we want to welcome them, because we're here to help anybody who supports our military and the Patriots out there. Next slide. Purpose. Why do we doing this? This is the reason we're doing it, because every one of the people on this call is either a Patriot or a veteran. And we are continuously trying to help our veterans understand that, hey, when you are out of the uniform, whether it be retirement, like Greg was mentioning, he retired in the Marines. We've got several folks on here either retired or getting ready to retire. We're wanting to build that, let's just say, that education and that ability to understand that there is a way that you can build and become financially free, and you don't have to go into a W-2 job. Like, you can do it, and it's all about taking action, doing exactly what you're doing tonight, surrounding yourself with people that are doing things that are much bigger than you are, And guess what? And we're here. And if you already are financially free, we're going to help you even gain even more advantage and build that legacy for your family in the future. Next.
Yeah. Okay, absolutely. So as Brett mentioned, we're here to serve veterans and patriots. Do you have to be a veteran? No, absolutely not. But our whole purpose is, if you don't love the country we live in here, then you're probably not part of our tribe. And there's a reason for that. So we want to thank all of you who are our tribe for being here and invite you to continue coming to these in the future. For right now, I'm going to turn over the floor here to our good friend, Julie Peterson. Julie is a loan officer with Old Capital Lending. Julie, I think it's been about 4 years or so, 5 years now. Is that probably about 5 years
that I've known you.
known each other?
Mm-hmm.
Yeah,
yes.
Yeah, exactly. So Julie, she's a loan officer with Old Capital Lending, who we've used before, and they're a fantastic lending agency. She's also a multifamily investor herself through her company Dancing Investments. And I'll let her tell you all a little bit more about her. And I was gonna originally play Dancing Queen as I introduced you, but I forgot, and I just don't want to have it any more time because like anything dancing is all about Julie. So Julie, I'm going to stop my screen share here and let you take over with your slides right now too. Yeah.
Okay, well, let me bring them up then. Sorry about that.
No worries.
We were playing around earlier. So let me just make sure that you guys can see these. Let me share. Boy. Okay, hold on. Where are you? There we go. Share. And here we go. Share. So you should see my screen, but I want to make it.
There we go. It's good.
Can we do, did it go away?
It's in the slide. It's showing your slides, but it's in the slide view. It's not like presenting.
Here we go. Now we're good. How's that look?
Good.
Yeah, there we go. That's the one.
Perfect. You don't see two slides, correct?
Nope.
Okay, perfect.
This is perfect.
All right, good. We're professional now. All right, well, welcome everybody. Thanks so much for the opportunity, you guys. I've been tracking you, especially Greg. I've been tracking for quite some time. Met JJ a couple years ago at a conference, and it was a real delight to meet with you and see what you guys are doing. So today I'm here because I want to make sure that everybody understands, as a passive investor, I know that that's a lot of you are passively investing, but also potentially as a general partner, what does it look like from the lending standpoint? So we're going to talk about my company, Old Capital. I work for Old Capital, some financing options, and then opening it up to questions and answers. So again, I'm with Old Capital Lending. We've been in business for 38 years. I've been doing business for 33 years in residential, and then got into multifamily about 15 years ago. So we at Old Capital have closed over 8,000 loans, which is a lot. We close typically yearly, 1.2 billion. And if we look at the Texas market, we close 1 in every 3 loans, which is a lot. So a lot of people know Old Capital because we have great relationships with not only lenders, but also with broker firms. So we also do a lot of business with education programs. So we do loans on all aspects of commercial real estate, but we really are specialists in multifamily. Again, I've been doing this for 33 years, and for so long, I was owning and operating my own single family, then got into a 12 unit, then got into a 20. And my lenders were like, just get away. We're done with you. Because they always told me, you need to have partners. And I was like, I'm not having partners. I can do this myself. I called it like, what's her name? Edna Mode. People think I look like Edna Mode. And she says, no capes. You cannot wear capes. But I was trying to wear a cape for a long time. And so once I took off the cape and said, I need to have some partners, that's when everything worked for me, started to really take off. So I'm a little different from a lender standpoint because I am an owner and operator. I've been in the trenches. I've capital raised millions of dollars. So in a lot of positions. I say that there's 3 positions in typically all of these deals. You have a capital raiser, you have an acquisitions manager, somebody who goes out and finds them, and then an asset manager who manages them. I've done all 3, and not a lot of lenders can say that. So when we're in a deal, I'm helping negotiate. I'm helping look at things a little bit differently. But from an education program or position, Old Capital really, really takes a lot of time to educate our investors. And so we do our Old Capital Conference, and all of you are welcome to join us. Old Capital Conference is October 9th and 10th in Dallas. You'll find all the people you need, brokers. You'll find obviously us lenders, investors. You'll find insurance and attorneys. So great place to go. I've put the websites there. The Old Capital podcast has been over, I think, 8 or 9 years that we've been doing it consistently. Paul Peebles, who owns Old Capital, and Michael Becker, who used to be a lender, they sit down every week or every couple times a month and talk about what's happening in the industry, in multifamily, in lending. So great place to listen at what's happening in the market. And then
That's one
lastly
of the
is
best podcasts out there too, Julie. That's
yeah,
that's how I got started. Well, not all of how I got started, but when I was just getting started in the industry, that was a big source of information for me, is listening to the Old Capital podcast.
yeah. I would agree with you, and I still learn from as an owner and operator and loan officer. So, and then last thing is Zoom at 8, and I do this every Tuesday night. You're all welcome. And this is a place where you will find partners, but also we have a live conversation with industry experts 3 weeks out of the month. So last night I had an education program came in, explained their program. So if you're looking for something a little bit more, Zoom at 8 might be a great place for you to develop your team or find investors. So that's a little bit about us. But I really was here to, I wanted to bring to you information because as a passive, because when you're looking at deals, you have to understand how these operators are looking at this deal. So not only are you trying to figure out who they are, but when they say, oh yeah, we've got the finance figured out, dig a little deeper. What do you need to know about lending? So first and foremost, you need to kind of figure out where you want to invest. And I always say invest in an area that's close by you. Well, I'm in California. I'm done with California. I don't recommend California because you're not going to have the cash flow that you'd get in some of the other areas. And in the bottom part of this map, you'll see, we call that the smile states. And these have been grossly impacted over the last 2 years because everybody said, I cannot get a deal, so I'm going to go build. And so we're seeing all of those people that got into multifamily 3 years ago, they're now delivering. And this is impacting a lot of these markets in those smile states. So I recommend, okay, maybe you don't do the smile states, maybe look at the Midwest. It might be a place immediately to take a look at. Now, the smile states are coming back, and that's Greg is going to a great place, although I'm going to miss him, to going to Phoenix. Phoenix grew by leaps and bounds, and there's a lot of infrastructure in Phoenix, but they're overbuilt, and it's going to take some time for all of that absorption to take place. And so in the meantime, rents are going to be a little bit lower. It'll take time to get those rents up. So thinking about what market should I be looking for and who's investing in those markets. Okay. And you're hearing
just a couple of years ago, it was kind of the other way around, wasn't it, Julie? Just a couple of years ago, the Sunbelt states are where it was at. And it was those up the Midwest states and the East Coast that no one was really investing in as much, and you weren't getting as good returns there.
100% agree with you. So things are different.
Even this is kind of a season though, too, so just because that's the way it is today and this year, this doesn't mean that's the way it'll be 12 months from now necessarily. I think there'll be some tendencies, but there'll be movement, of course, too, back in the right direction, I think, depending on the market.
I do agree with you. So it's understanding the market where we are today, where we're going, but nonetheless, the fundamentals are still here. we're seeing some rent growth, and I wasn't going to go too much into what's happening in the market, but if you've turned on your TV or if you've tried to buy a house, you know that the interest rates are up, and they went up considerably back in 2000. Well, we had the COVID, everything went to, hell in a handbag, and then everybody jumped in using bridge lending and didn't recognize that, what's going to happen with these adjustable rate bridge loans. They went up and they went up and they went up, and they didn't stop going up until 9 or 10, 11 interest rate increases. And we've stayed there historically, not where we've seen the market and inflation. So the combination of interest rates, inflation, jobs, delivery, it's caused some sense of concern for investors. So we want to make sure that you understand, there is a risk in all investments, whether it's the stock market or it's multifamily or it's, senior housing, whatever. But if you say, what is a normal interest rate? We're not that far off. We really aren't. So really want to make sure that you get a sense of where are we going and how do we get these deals done. Now, as a lender, we call ourselves bankers because people come to us for money, whether it's going to be from a bank standpoint, bridge. There's a couple different kinds of bridge. We've got fixed and adjustable. We have agency, which we call the gold standard. That's your Fannie and Freddie. They also have Fannie and Freddie on the residential side, but this is different. This is going to be non-recourse, which we'll get into. We have CMBS, hard money, gap funding. If you just can't get over that last 500,000, we can help with that. Life insurance companies are also get into this. And then another government-backed entity is HUD housing, HUD financing, FHA is another. So we're going to spend time today talking about agency, bridge, and bank, because that's where you're going to see the majority of these deals getting financing. But before we do that, I think it's very important that everybody understands what is recourse lending versus non-recourse lending. And I would like to see a hands, and maybe you can find the little thumbs up if you are aware of what recourse versus non-recourse lending looks like.
Yeah, if you go to the reactions button on the Zoom browser at the bottom, there should be an option to put your thumbs up or raise a hand or something like that.
And Greg, I can't see that, so if you would just tell me what that looks like, and then I'll get to understand. So I'll go either real in depth or we'll just do a quick overview.
Well, if you can see the people, the thumbnails of people who are participating, sorry, I may mispronounce your name. Vibeke just had her thumb up just a second ago. It showed up on that thing. So let's see who else. Anyone else?
So everybody else. Okay.
Julie, I think we have a wide range of individuals. We've got, some folks that have done several deals. We've got folks that are brand new. So if you just want to go in at a 30,000 foot level, that'd be awesome.
Perfect. So recourse, if you think about when you buy your home, they're going to look at your tax returns. They're going to find out what income you have. Have you been having a job for a while? Recourse is a personal guarantee. So if something were to happen where you were managing this property and everybody moves out, you have a master lease, everybody moves out, and you have no income coming in, you go to sell that asset and you sell it at a loss. You are personally responsible. Each person is 100% responsible for that default, for that difference. So I'm going to be responsible for the $3 million. Greg is going to be from $3 million, and so is JJ. Okay, we're partners. We are 100% liable for that. Honestly, deals you're always going to be liable for some way, somehow. So I don't want to say don't do recourse because that's dumb. You want to have an option. So I like recourse. There are reasons why we will do recourse, and we'll talk about those in just a second. Versus non-recourse, which is, yes, you're signing on the loan. You're guaranteeing that your LLC is going to be making payments. But if there's a downfall and a shortfall, I should say, you are not personally liable for that shortfall. So why wouldn't you want to have non-recourse? It separates you from some losses. Here's the thing. If you have illegal behavior, let's say you have bankruptcy in the middle and you don't disclose that, that could be a possibility that would go from non-recourse to recourse. We call that bad boy carve-outs. So as long as you're behaving nicely and doing what you can, then it will stay non-recourse. We have seen people in this industry that have had bad behavior and it goes into recourse. So you want to be careful. You know, agency is a great way to get these deals done. And the majority of people in multifamily use this type of lending. But you want to make sure that you're doing exactly what they're asking, right? You want to take care of your deferred maintenance. You want to give them all of their reports. So it's a little bit more reporting, but we highly recommend this type of lending. Are there any questions
Julie,
on recourse?
For recourse versus non-recourse, how does it affect things for passive investors? Does it change their risk whatsoever?
No,
or how does that affect them?
it does not affect their risk. You know, if you think about, and we use this analogy quite a bit, as a flight, right? The general partners are the pilots in a airplane.
Yeah.
So they're flying it. The general partners are navigating. The limited partners, and they're taking on responsibility. The limited partners are all of the people in the back of the plane. They're, you know, getting served, they're getting their reports, they're getting, you know, updates, how the flight's going, but they do not take any responsibility for the loan or how this asset is performing, good or bad, right? So we're always hoping that it's going in the right direction. But if there was a default and you were in a recourse loan, you as the limited partner would not have any quote unquote recourse to that you would be responsible for.
Yeah, I was talking with Rob the other day here, who's on the call, about the difference. And this is something that comes up a lot when I talk to potential investors. They don't understand what the advantage might be for investing passively in a syndication versus just going out and buying a rental property on their own with it that they own and they control by themselves. And there's pluses and minuses. One plus for that would be control, but a huge minus would be like what you just said. Now you're taking a recourse loan out on your own credit report and if something happens, well, they can go after everything you have up to the limit of that loan. So yeah. Whereas with as a passive investor, you're not on the hook for the loan and you're not on the hook for anything past the amount of your investment.
Yeah, absolutely. And listen, when I finally said, hey, I want to go to the next level, my husband said, I am out, I'm done. And I said, well, I'm not done. I want to go and continue my this buying and owning. And I went in, I transferred all of my active into passive, into larger deals. And one of the things that I loved is that I didn't have to call my husband to fix up any of the maintenance, which was great for me. But what I really missed is that I was used to looking at my operating statement every day. What's happening? Where are the tenants? All of this. I was used to that. When I got into a passive opportunity, I didn't see that. I saw it on a quarterly basis. I even saw it on a yearly basis. And I knew that for me, that was not going to work. I needed to see it more often. And even as a passive investor on a monthly basis, sometimes that makes me crazy because I like to know what's going on. So that's some of the things that you want to be thinking about. If that's something that you want to know things more, get updated more often, then go with an investment group that has those updates, or ask, hey, if you're doing these quarterly, can I get a monthly update? So those, because that's what worked for me. Just something to be thinking about.
Absolutely. It's a great point.
And most likely, Julie, you probably wouldn't invest in an operating group if they wouldn't be willing to do that. So that's probably a question that you're doing in advance. You're talking with before you actually send over and wire your funds. You're saying, hey, this is what I'm going to require as an LP. Are you guys willing to do that? And if they're not, then you wouldn't invest with them, right?
Absolutely. Great point. And in our operating agreement or PPM, it will say that we are required to provide you with quarterly reports. So, we put that up front, but we have done monthly, especially in this time and in this environment. We want to make sure that everybody feels secure. And so you have that conversation beforehand. Great point. All right, let's carry on.
Real quick, Julie,
yeah.
there's a question in the chat box from William. He's asking whether recourse versus non-recourse affects the loan rates or fees.
It does. So recourse is going to be on your bank financing. And we're going to get all into this. When we look at, I showed you that map, and in the Midwest, you've got great rental growth in the Midwest. So the NOI, the net operating income, has increased in those markets. So a lot of lenders, whether it's agency or bank, so that's recourse or non-recourse, they're bullish in that market. They're going to give more deals to those markets, where maybe in some areas where they're not making as much, rent growth, we've got some occupancy challenges, they're going to be pulling back. So depending on the market, if it's a tertiary market, you may not get as much leverage from, let's say, the agency, and you might get better leverage from the bank, which is recourse. So it is a challenge, and that's what we do. We marry the right financing with the business plan and where it is. We're really specialists in that. Does that make sense? You good? Okay. So I want to bring to your attention agency. Again, this is your gold standard. And for those of you who are thinking about, hey, maybe I want to be a general partner, this would be good information for you to write down or take a picture. If you are a passive investor and that's all you want to do, this is an idea of what the general partners need to qualify. This is what they have to, the guidelines they need to be qualified for. Okay, so there's 4 requirements. 1, and again, this is Fannie or Freddie. We call it agency, and each one has little different nuances. I'll try and point those out, but for the most part, we're going to talk about agency as a whole. So 90% occupied for 90 days. So the assets that agency wants to have are quote unquote stabilized assets. And when we say stabilized, we're first looking at that as 90% occupied. Now, stabilized could also mean that we've got regular cash flow, we've got occupancy, but the rents are really low. That in some cases, that would be considered an unstabilized asset. And so it'll depend. Agency is really longer term debt, longer term amortization, so lower monthly payments than what you would find on a bank loan, let's say. So the first one, 90% occupied for 90 days. And it needs to remain at 90% occupied. Otherwise, it could get kicked out. Second is net worth greater than the loan amount, equal to or greater. So net worth, that is going to be your assets minus your liabilities. Each one of you has a net worth. Do you know what that is? Have you ever done a personal financial statement or a schedule of real estate? This is what we're going to look at as a lender, how much you're valued as. And then what I like to do is do that up front and to figure out, hey, what do you need for your team? You're worth $1 million and you're going towards a $10 million deal. You're going to need to find some partners. So it's great to know your net worth and then go out and try and find, I'm looking for somebody who's worth 8 million, because that's what the assets I'm looking at. So really good to know what your net worth is, and then a roadmap for who you're looking for. Third is liquidity. And liquidity is cash in the bank or marketable securities. Now, marketable securities could be considered your insurance policy that your husband took out on you that's worth $10 million. I know you guys love each other, but there's something going on there. No, just kidding. There is a cash value to that marketable security. That's what you get to use. And if you have a $10 million policy, it's probably only worth 50 to 100,000, depending on how long you've owned it. But that's one way called this type of liquidity. The other one is going to be your stocks and bonds. So there's a cash value of your Google stock, your Apple, Oracle, all of those have a value. So we're going to want to know that. If you've got a lot of stocks, you are really well positioned to become part of a general partnership, because a lot of operators, we like to put our money into deals. We don't like to have money sitting around. So if you have a large amount of liquidity, you can start to ask some of these groups, hey, I'd love to bring this liquidity. So think about that. One thing you got to know is cash in the bank is not part of your IRA, okay? Because you're going to find net worth and you're going to add that into your net worth, but it doesn't show up as liquidity. So anything that's wrapped in a 401k or an IRA cannot be used for your liquidity, okay? And then the last piece is experience. So again, we've got 3 people in the room that are operators. These are the people you want to use if you're looking to build your business in a partnership. Okay, Greg, JJ, and Brett, they all have done this before. Okay, so you're going to use their experience. What we're going to look at from multifamily side is 2 years of experience. Now, if you come from single family and you have 10 doors and you've owned them for 2 years, agency just opened that up and said, we will allow you in. They didn't do that for me 15 years ago. They said, go away. So this is a great thing. If you know some family members that have a large portfolio of single families, go knock on their door. See if they will be your sponsor. Could be a great way to start your business. Now, the one thing that nobody talks about is this equity. The people who are operating these deals, they need to have money in the deal as well. They don't just walk in and get it for free. They have to put their own money in. And the guideline says, of the equity brought in, I need you to have 5 to 10% of your own capital. So you can come in without any money, but you have to have the right partners that would support that, all of these requirements. So
Yeah,
let's
the team as a whole has to have skin in the game, right?
Exactly. But maybe, Greg, you don't have skin in the game, but you're part of the team and your rest of your partners are going to. What does that look
Absolutely.
like when Greg is going out and saying, hey, can you bring money into my deal? And somebody says, and every one of you should ask this question, how much money are you putting into this deal? If Greg says nothing, that doesn't necessarily give you a good sense that he's in support of this. Greg and this team, they're going to put money in the deal. And so they want you to be alongside them, right? So I want to give you an example of how this works. Again, this is your top-notch type of lending. $10 million deal. Right now we're transacting between 65 and 70. And so for this example, we're going to just say, I'm bringing 7 million. Your lender is your biggest partner. I'm bringing the most amount of money. We're going to build a great relationship. So what I need from you is a net worth of, remember, it's equal to or greater of net worth of the loan amount. So I need 7 million in net worth. I need 10% in liquidity. That's 700,000. I need you to have your experience. Now, we'd love it if it was in Fannie and Freddie, but by the way, we will take bank. We will take experience, again, on the single family. And then I'm going to look for I'm bringing 7, you're bringing 3 on your equity. I need 10% from your team. So you guys are going to need to bring 150 to 300,000 in capital to the transaction. So that's really important. I broke it down very carefully and succinct. So what
Julie,
do
I
these?
want to put a quick plug in if you don't mind, real
Yeah.
fast. About 7 million in net worth, and emission net worth is one of the requirements in the last slide. So there's quite a few people here attending who are maybe they're still serving in the military or they're military veterans. Once they're out of the military, or possibly even while they're still in the reserves, they can get a VA disability rating. And if they have their VA disability rating is over 50%, then they are getting I'm getting too technical. So if they have a disability rating, they may be getting funds from the VA, non-taxable funds, but that's income for them. And for people who haven't thought about it, if you have your IRA and you're putting together a loan application, okay, or your 401k, what you put on the income portion on your income statement, because whether you're getting making any withdrawals from it or not. And you see a plan balance that you can put as an asset on the balance sheet. But for something like VA disability benefits or military retirement, we never see any plan balance. All we know is what the income is that we get every month. So there is a way that we can value that, calculate the present value of those annuity streams to include on our personal financial statements. And that can make the difference between whether an investor is non-accredited versus accredited. For people who are trying to be active investors and trying to sponsor deals in their own right, that they may have a higher net worth than what they think they do. So I don't want to go into any more detail on that, but I do have a short video on it. People who are in my investor club have already been sent that video, and feel free to reach out to me, whether it's directly or through Brett and JJ, and I'm happy to provide that for anyone who's interested.
Great information. I didn't know about that, so that's awesome. All right, so agency financing is going to start at $1 million. So you're going to be looking at deals that are, let's say, 1.5. Once we put a 70% loan on that, it's going to be right around $1 million. So I would start, if this is something that you're looking at as a general partner, start at 1.5. So these loans are 5-year, 7, 10, 12-year loans. You're not going to get that in the bank. These are a lot of flexibility. What we do is we start with the 10-year treasury. So if you were to Google 10-year treasury, you would find out that today's rate, earlier today, it was 4.32. Yesterday, it was 4.25. It fluctuates, and it fluctuates by the minute. So when you sit down, or when operator comes to me and says, well, what's the rate? I will look at the 10-year treasury, and this is how we make up interest rates. It's the 10-year treasury, or the 5 or the 7, depending on how long you want to be in this. And we use a spread. So for today, if we're looking, let's say, at a $10 million deal at 7 million, I'm going to put that in our small balance. I would say the spread is going to be about 250, 2.50. So 4.32 plus 250 is 682. So that's the rate. And we're going to get into—
What does that spread mean, Julie? What does that
the spread
actually
is
do?
how the lender, the capital markets, gets paid. So when there's a whole bunch of money on the sidelines and they're placing capital, they won't take as much payment. It's like a commission, if you will. But when money is tight, they're going to want to get paid a little bit more, because it's harder to get these deals done. You got to get support. You have to, these deals are a little bit more challenging right now, whether it's because of, money is tight, or we've got, some of the challenges in the market. So
And they're taking more risks, so they get paid for that.
Thank you. Yeah. Yep. Leverage, depending on the market. If you're in Dallas, or you're Boston, San Diego, Los Angeles, Jacksonville, Miami, those are going to be 80% levered loans. That means the max dollars that I'm going to bring to you is 80. In a top, that's a top market. In a standard market, it's going to be around 75. I will tell you that even in Dallas, we're underwriting deals between 60 and 70%. So if you are looking at a deal and it says 80% when they've underwritten it, I would ask questions. Write that down. If somebody is saying I'm getting an 80% levered loan, that you need to have a light bulb go on and go, tell me more about that, because that's not what's happening in today's market. It can down the road, but because the net operating income is not as high as the value that people are putting on these assets, we're not able to cover a debt service and give you the max leverage. So don't want to go too deep into that. But these loans will offer 1 to 12 years of interest only. So all of this money is coming in and you're able to have cash flow out to your investors. It is amazing. 30-year amortization. So you're going to have lower monthly payments. Again, more cash flow, costs you 1%. And then there's these prepayment penalties. Now, in residential, there are no prepayment penalties. Years ago there was, but you can have a loan one day and sell it the next day. So let's talk about the prepayment penalty. There's a thing called yield maintenance and step down prepay. And I'm going to make the assumption, take the assumption that nobody knows what that is. So let's unpack it. So you're going to come to me and you're going to, or the investor has come to the lender and said, hey, tell me how much your interest is, I'm going to have to pay on this. I'm going to try, most lenders are going to try and give them the lowest rate. And that's going to be found on a yield maintenance penalty. And what that says is that I'm going to own this. Let's say I'm selling them a 5-year loan. And the operator says, I'm holding this for 5 years. We're going to sell them the 5-year loan with the idea that they're going to go to maturity. That means there's no prepayment penalty if they hold this asset until 90 days before close. There's no prepayment penalty after the 90 days. No prepayment penalty. It stops at 90 days before close. Okay. Here's kind of let me unpack this a little more. So you come to me, you say, here's today's rate is 682. And you're going to hold this for 5 years. If you decide in year 3 that I want to get out, our business plan is covered. I go to the capital markets and say, hey, Brett wants to get out of this deal. How much is it for him? What's the prepayment penalty? Well, if the interest rates go up from my 682 that I sold it to 8%, the capital markets is like, yay, I can take my capital that I just sold to you for 682 and I'm going to go sell it to the next group for 8%. So the prepayment penalty is minimized because they don't have to, there's no making them whole. They can move out of that. There will be a penalty, but it's low. Versus this idea of a step down prepayment. So if we take a 5-year loan, 1, 2, 3, 4, 5, on the first year, it's 5% exit fee. That's your prepayment penalty. Second year is 4, third year is 3, 2, and 1. So in that same example, you're coming to me and saying, Julie, I want to get out in year 3. I told you I'm not sure with yield maintenance, but in the step down, it's 3%. Remember, 5, 4, 3, 2, 1. So you're going to pay in rate up front per month, right? The interest rate is going to be determined depending on the type of prepayment penalty. So this is another question you need to ask the operator. Do we have yield maintenance or do we have step down? If it's yield maintenance, you don't know how much it's going to cost to get out of that loan. If it is step down, it's very clear. It's like throwing a feather into the wind with yield maintenance. You just don't know. But if you're going to stay in that loan for the duration, it's the way to go. Okay.
So it sounds like coming into a new business plan, a new acquisition is kind of a choice between having a lower interest rate and taking some uncertainty on the prepayment penalty versus a little higher interest rate for more certainty and lower on the prepayment penalty. Does that sound accurate?
That is correct. So if we look at, again, I told you the yield maintenance penalty is 682. If you get into a step down prepayment, it's going to add another 80 basis points. So instead of 682, you're going to need to price this at 762. So it's going to add so you can sleep at night. But that's something that your operating or your operators will want to look at. And you'll want to ask those questions. How much is it going to cost me to get out of this? Really important.
That's a lesson I learned the hard way. One of my earlier acquisitions, we used yield maintenance, and we bought that about a year before COVID hit, and then COVID hit, the interest rates dropped through the floorboard, and so when the interest rates go down, the amount of the prepayment penalty, if we had sold then, went way up, and all of a sudden it would have cost us like $2.5 million in prepayment penalty to get out of that, which is a heck of a lot more than 5% or 4% and 3%. So. Yeah,
absolutely. And that did happen to me as well. It was 2 million to get out and we decided not to sell. So this needs to be determined before we get into the deal, and your operator as well. All right. So the other things that are happening today in this market are assumptions. There's a lot of people that got in with COVID that used agency financing and they've got low rates and they want to get out. It's time for them to move on. So if the operator that you're working with, here are our operators here today, if they find an assumable loan, it might be a great option. Of course, it doesn't help us from a lending standpoint, but it really could help you as an investor, all right, and an operator as well. Some of the things to be thinking about and asking the questions. You want to be careful because a deal that only has 3 or 4 and potentially 5 years left, there's not enough runway. Yes, it has a low interest rate of 3.75, but when your business plan is 7, because a lot of these deals are taking longer to return your capital, you're going to need to go get another loan. And we don't know what that looks like in 4 or 5 years, let alone 3. So it's difficult to underwrite them. You really need to cost them out together. And looking for something that has a little bit longer maturity would be the way to go on that. You want to make sure that we haven't gone into cap rates, and we won't spend any time today on cap rates, but you don't want to be over leveraging, and we call it negative leveraging these deals. That way you'd be losing day one. Okay, so assumptions could be great. You just have to know a little bit more to dig in. Let's talk about fixed bridge. But before we go into that, we talked about stabilized assets. Okay, a 90% occupied for 90 days asset could be considered, it's stabilized, but it also can be unstabilized where you need to raise the rents. So we would look at a fixed bridge product, but you'd also look at a bridge product, or whether it's adjustable or fixed, when you have a CapEx budget. That means a renovation. In order to raise these rents $100, I need to put in $5,000 a door. That's when you would use the product, or you would use bank. And we'll go through that real quickly. This is a non-recourse product. It starts a little bit more expensive. I told you agency is around $657, right? A fixed bridge is around 10, $875 to $11, but I always say let's talk about 10%. So if you're looking at any deals today that have bridge and it's fixed, take a look at that. It's very important. These are 2 to 3 year loans where they're interest only. Never is going to change that payment, but it's interest only. I love it. And you would have the opportunity to potentially extend it. So in year 2, right before it matures, you could go back and say, hey, I need another year. It would cost you 1%. You would do more of your business plan. You say, wait, I need another year. So that 2-year could become a 4-year loan, or a 3-year could become a 5-year loan. So that's a great option. I love it. And you're going to get much better leverage. So if we talk about that $10 million loan we talked about on the last slide, I'm giving you $7 million on agency. On fixed bridge, potentially 75%. So I'm giving you $7.5 million in a loan. So that's one thing. Then I'm going to give you more money for your CapEx. Let's say you want to put $1 million into this. I'm going to give you potentially 100% of that. So not only have I given you 7.5, I'm going to give you another million. That's 8.5. So 8.5 of a $10 million deal or 11, it's really close to 80, 85% on some of these deals. So if you're a capital raiser, which product do you want to use? One where you have to bring in 3 million or 1.5 to 2? And this is why fixed bridge is so cool, but it has to make sense. It's much more expensive. You have to have a good team to do those renovations, get people in and out so that you can move on to your business plan to hopefully go to an agency. Now, maybe your business plan is, I'm just going to sell it. That's a great business plan. A lot of people use fixed bridge for that, but also to go into a perm loan, and that's when we would do agency. So these close very fast, 30 days. I like to do them a little longer, but we can get them done. There is this thing called the adjustable bridge, and if you've been around the block for a couple minutes, you'll know about an adjustable rate bridge. This is where we got into it. Interest rates went through the roof. We're dealing with that on a lot of deals right now. And listen, you can take out an adjustable rate bridge today. I don't think anybody would say that's a wrong decision. It just depends on your business plan. Okay. If it's a large deal, 20 million or more, and you've got a fairly large CapEx budget, this may be your way to go. Here's the thing. I recommend if you're going to use this, you're going to want to buy a rate cap, and many people, a lot of lenders will require it. They did not require it earlier in the season, but now they do. And I also would capital raise a large amount of reserves just in case something comes up. So these right now are transacting around 9.5. And we're looking for, this is run on the Fed, the Fed funds. You're hearing Jerome Powell say, we're not going to move those. This is the index that we're talking about. SOFR, it's the short-term Fed funds. We're looking to get these down so these people can move out of these and sell them or refinance them. But there is a huge cost for these rate caps. This is like an insurance policy. So it is saying, hey, listen, if the rate goes up, I want to be covered. So in this example, this is a $20 million loan. It's going to cost me, if I look at, just this highlighted, this is saying that if the rates go from today is 550, if they go up to 750, I'm going to be covered. If it goes to 770, I don't have to pay that difference. It'll be refunded to me. I'll have to pay it, but then I get a refund from the insurance company, basically. But that policy for 3 years is going to cost me $1,189,000. Now, how many of you have that money sitting in the bank to buy one of these? I don't even like paying for my car insurance, let alone a rate cap. So these are really expensive. They're going to come down very soon. But if you're transacting in today's market, this is very valid, very expensive. So I say, stay away from the adjustable right now. Go to a fixed if you need it, or see maybe if you want to go to bank financing. There's nothing wrong with bank financing. Again, it's recourse. And you can start these at 200,000. Old Capital, we start at $1 million, but these are great loans. They're your local, your regional, your national banks and credit unions. So typically as a whole, because every bank is different, you're going to find 5-year loans on a 20 to 25-year amortization. So the every monthly payment is going to be a little higher than agency. Your rate is a little bit higher, 7 to 9%. You're going to get maybe potentially a little bit more loan dollars, but your monthly payment is going to be more. So you got it. We will look at this on every deal. What is your best strategy? Okay. You're still going to need net worth and liquidity, but depending on what the occupancy is, bank financing might be your only option. One of the things that we're seeing right now with bank financing is they're asking for a deposit. Now, remember, this is local banks. They want to have a relationship with you. And so, yes, you're going to give them your business account, right? The one that you're going to be operating on. But what they also want is about 10 to 15% of the loan amount to be put into their bank as a deposit, because the banks lend out money based on their deposits. So somebody put money into their bank, they're giving you a loan. Now they're asking you to put money in so they can continue to loan. Most people don't want to put and hold 10 to 15% in a local bank. I don't want to. I want to deploy it where I can know I can get maybe higher returns. But again, it might be the right fit. So don't say I don't want to do that. Look into it. I will tell you that in 48 hours, I can return to you or your operator how much a agency loan lender is going to provide. When we go to banks, they have committees. They want to know a little bit more about you. They want to see in your, your stuff. They want to see your tax returns. They want to see who you are. Not so much on agency. We're going to use your net worth and liquidity. So bank can be a little bit invasive, but it might be your best strategy. All of this to say, the most important thing you want to take from investing in multifamily, in real estate, is know the team that you're investing with. You never want to go in blindly. You could run some credit scores. You could get into, what am I trying to say? You could do a background check, okay? It doesn't really matter what the interest rate is if this group cannot deliver, okay? So do due diligence. Ask them questions. How many deals have they done in the past? What can I expect on reports? What are my returns going to look like? Right? These are all important questions to be asking your operator, as well as if you're going to be doing this as a general partner, who are you getting in business with? What is their character like? I have a couple partners that have not done good by me, and I didn't necessarily think that was what I was going to get, what I was getting into. So be really, really careful. Okay. And now listen, when others are, this is Warren Buffett, and I'm sure many of you have seen this, but when others are fearful, you want to be greedy. And when others are greedy, you want to be fearful, because maybe that's not the right time to buy. People are fearful right now. So get out there and start investing, whether it's as a limited partner or an operator. Get your hands and get your feet wet into these deals. My question to you is, are you ready? Are you ready to take the next step? So I want to thank you, everybody, for giving me the opportunity to share about lending. I hope it was helpful. This is my contact information. You're welcome to come to my Zoom at 8. It's a great resource. Come to our old Capital Conference, and find me on LinkedIn and social media. Make sure you send me a note that, hey, I saw you on the Patriots webinar. So I'm
Julie,
going to
what's the
open
best
it
way
up.
for people to find your Zoom at 8 registration link, by the way?
Well, you would just go to dancinginvestments.com. dancinginvestments.com. Remember, there is a password that comes with that, so you want to take note of that so you can enter in.
Okay.
Any questions tonight?
Tell you what, you mentioned about the cost of rate caps a few minutes ago, Julie. That almost $1.2 million rate cap you had up there. How much do you think that would have cost 3 or 4 years ago?
Well, 3 or 4 years ago, probably cost $74,000.
Exactly.
Maybe $100,000.
Exactly. And that's how some people with floating rate loans got in some degree of trouble, because they had a prepayment penalty. I'm sorry, prepayment penalty. I'm using the wrong terminology here. They had a rate cap that came with a very low cost when they first bought the property. and then
Yeah.
the costs went through the roof to be able to replace it. Or if it was a floating rate agency loan, which does exist, of course, then the agency makes you escrow in your mortgage payment for a replacement the whole time, and people's mortgage payments pay for the replacement rate cap escrow went through the roof unexpectedly. So definitely every tool has its purpose and has its place and the right scenario for it to be used. So you just have to understand what those right scenarios are, and connecting with someone like Julie is a great way to do that. She'll steer you in the right direction for sure.
Yeah, and listen, we do a lot of business with a lot of operators. We know their background, we know their deals, we know their locations. Happy to be a resource for you. But you've got really good operators in the room here. A lot to share with them, and they can really steer you well as well. Thank you.
Absolutely.
And Julie, just to piggyback on what you just said there, as far as the old Capital podcast and having the ability to reach out to your team, whether it be James Ing. I mean, we even had coffee with Paul Peebles, who attends my church right here in Colleyville. He's just an amazing individual as well. So your group, Julie, has been incredible, and I just wanted to make sure that our team, and we're so thankful to have you as an expert in the lending side come on tonight. So thank you so much, Julie.
Sure, absolutely. Happy to help.
Fantastic. Yeah, really appreciate it, Julie.
Mm-hmm.
Before we go real quick, we just want to mention this deal we've been advertising for a little bit for people who are in our who we already have existing relationships with. Midtown on First, we did close on this deal just a couple weeks ago in Tucson, Arizona, 94 units. We are still raising for the to finish up the capital expense budget. So if anyone took a look at this and already has an existing relationship with us, and just didn't have the time to pay enough attention to it at the time, if you might be interested, feel free to reach back out to one of us and have a conversation about it. So we've already closed, so that de-risks the investment. And since we're talking about lending, I'll mention real quick that we got this at a very low cost, 13.6 million. So it was roughly a 30% discount because it was under contract a year earlier for 19 million, and the buyer couldn't close. So it went back to market, and we got it at a really low price. We were able to actually get 74% loan to value on a Freddie loan with step down prepayment penalty on this. And just like you were talking about in your presentation, Julie, we paid extra in our interest rate to get that step down prepayment penalty, because everything is a balance. You got to do the balancing act on where the right mix is for the particular deal. So yeah, we did a 7-year loan on this, 7-year Freddie Mac loan with step down. So 5544321. And yeah, we're really excited about this. We're right out of the starting gates. I was at the property 2 weeks ago, since I'm in Arizona all the time, and before long I'll be living there, and not in Tucson, but in Phoenix, but I'll be close by to Tucson, so I'll be there even a lot more often.
So
my fourth asset there.
Yeah,
so,
that's what I want to say, guys. What is really critical here is Greg has other assets in Tucson that's really, really valuable. And Tucson is an excellent market. So don't put Phoenix alongside Tucson. Tucson is doing really, really well. So just something to be thinking about.
Yeah, Phoenix is a little more volatile. It has a little wilder swings than Tucson does. Tucson's kind of the more steady eddy of the market of the two of them.
Yeah.
And Greg and I had the opportunity to bring this to our 10X Vets team to actually have it scrubbed. Unfortunately, we were a little bit late bringing it to the team and having them review it and poke holes in it and literally review it to a point where he was very comfortable with this deal, and said, if you have another deal like this, bring it to the team on our syndicate team, and we will help you raise those funds. So just so you know, like, there's folks in our communities that understand how good this deal is, and that's why Greg and I wanted to bring it to our team here tonight.
Absolutely. Well, wrapping up, we appreciate everyone being here with us this evening. Our next session is going to be on Wednesday, July 31st, same time. While it's up on your screen, you can use this QR code to register. And just point of clarification, these QR codes down here, these are for our individual companies. If you want to connect with either of us and haven't done so before, you use this QR code to get to my contact information. Or this QR code to get to Brett and JJ's with B.A.B. Investments. For the time being, we're still separate companies, although that could change at some point here in the near future. We'll leave that for another announcement.
And make sure you guys don't hesitate to use those QR codes right there and to reach out at any time. That's one of the most important things that as limited partners, we only invest with groups that are willing to jump on a call with us at any time. And we are the same way. So do not hesitate to get on that QR code, and our calendars are on there. You can schedule a time that works for you. And more than happy, obviously, as you can see, we are super excited about multifamily investing, whether it be motel conversions, whether it be the value add properties that we're doing in Tucson, and just love talking about it and helping educate our tribe all around. So don't hesitate to reach out.
Absolutely. Well, Julie, once again, thanks for coming on and presenting to everyone tonight. We really appreciate your expertise and willingness to talk tonight. Brett, anything else you want to close out with?
No, sir. And just thanks everybody for joining. Y'all have a good rest of your evening. Julie, thank you so much again. Looking forward to keeping in contact with everybody on this call. And if you guys have any questions at all, feel free to reach out.
Absolutely. And I'm sure JJ says goodbye too. He had to duck out at the top of the hour because it's actually his anniversary, and he had a date with his wife that he had to go get to. So I can't blame him for that. So he knows his priorities.
First things first. First things first.
Exactly.
Y'all
All right,
have a good evening.
Thanks for coming.
Thank you.
Have a great night.